Hey guys, I hope you're doing very well. My name is Colin. This is Colin Talks Crypto. If you've been following me for a while, you know that I made a video several months ago where I correlated various economic indicators such as the yield curve inversion, the federal funds rate, and the S&P 500 and how they all track and correlate together, especially as relates past economic recessions. So I'm going to do this video because it's been several months since that initial video. It's time for an update. And I also want to make this video to really make it clear. I want to just take a few moments here to really hit home the fact that it is possible for a rally to occur much longer than many of us would expect. And the fact that the delay between when you'd expect a crash to occur and when it actually occurs can be several years in length. Well, a lot of us care what happens in the interim, in that couple of years potentially up until the crash. And like I said back in February, I think it was, we have up to 14 months of rally before the crash occurs. Now here we are currently in July. So what is that? March, April, May, June, July. So that's 5 months that have gone by. So now we have up to about 9 months of rally possible. It could be 0 months, it could be 9 months. That is also still true. And as we have seen over the last 4 or 5 months since I made that last video, the markets have continued to rally. This is expected behavior, and this does line up with what we've seen in past economic crashes, or at least leading up to those crashes. And I want to introduce a new metric that fits right in with this, that further compounds why I am so certain that we are heading into, eventually, a massive economic downturn, not a soft landing, very much a hard landing, very much a huge, 50% type drop from all-time highs. And I want to get into that. And the metric that I'm adding is the unemployment rate. The unemployment rate fits right in with all of these as another telling indicator. And so when I turn off my video here and we flip to the screens, you will see as I line everything up for you and how it just becomes ridiculously obvious that to expect there not to be a crash would be ridiculous. And I would say it more gently like this. If you can't even factor in the possibility that there could be a massive economic downturn, that would actually be an error in logic because the evidence in front of us is so preponderous. And so anyone who is just saying it's not possible, it's up only from here, and they're not even giving a chance, they're not even weighting in their mind a factor chance that there could be a catastrophic collapse, given what I'm going to show you, I think that is a massive error. Now, I'm on the other end of the spectrum. I'm not quite so conservative in thinking that there's just a chance. I think that it is a likely outcome. But first of all, let's get into the indicators and let's look at how they all line up and what we could be in store for the next several months. How long could this rally go for as it relates at least to the past economic crashes, specifically 2000 and 2008? How high could the markets go? How high could the stock market go? How high could Bitcoin go before they begin crashing? And so it's a twofold thing. It's a bullish video for the short term and the medium term, and it's definitely got a bearish undertone for the long term. I'm not fixated on only bearish, only bullish. I'm really trying to encompass the entire time spectrum so that I can be positioned for all different outcomes correctly. And I know that, first of all, it's impossible to do that perfectly, absolutely. But it's good to have a plan. It's good to have at least what you think is going to happen. And it's the most important to be able to be flexible. And as long as you're flexible and you understand that things can change and that you can be wrong, then it's okay to have a plan of the most likely outcome as you see it. Now let's jump into these metrics, and especially this unemployment metric that I'm adding to the mix. And I'll just review and show you where we're at now and how it has lined up perfectly. Like the Fed rate has climbed. It's beginning to plateau just as expected, right? Maybe the Fed does another rate increase or two, but it looks like it's slowing down and it looks like we're basically going to go flat for a while. This lines up exactly with what I've been showing you guys on this particular thing. In that regard, my long-term projection has not changed and the pattern has not changed from 6 months ago when I first made the video. So here we go, guys. Let's dive into it. I hope you enjoy. I've made a bit of a presentation. I'm going to go over an overview real quick of everything so that you can see what we're going to cover. This screen may look familiar to you, and we'll cover this first with the addition of the unemployment rate down here. Now, some of the other things I'm going to share with you are some charts from this particular article by Benjamin Miller. And these charts here, which zoom in on each of the past crashes and give us a real granular look at why I'm saying what I'm saying from a slightly different perspective, but essentially saying the same thing. And we're going to cover the late 60s, the early 1970s, the dot-com bubble, the early 1980s, and the Great Housing Crisis or the Great Recession. We're going to cover the overall averages, and we're also going to start with, right here, some basic understanding. Again, fundamentals of why I'm saying what I'm saying. So the inverted yield curve, as we're going to talk about on this chart, the inverted yield curve is represented on this chart in this section right down here by the green and red color. Anytime this indicator flashes green, the yield curve is not inverted. And anytime the indicator flashes red, like these times here, which means the yield curve is inverted. Okay, so let's go back. Let's look at the yield curve. Now, why do I consider this such an important metric? I keep talking about it. Well, why am I talking about it? Well, look at this chart here. This is gurufocus.com. And this chart specifically here on the left, we're looking at the spread between the 10-year and 1-year bonds. Now, let's back that up a step. What does that mean, and why is this important? So when you invest in bonds, you would expect a higher return for the longer the bond maturity date is. If you lock it up for 30 years, logically you would expect to get a greater return on that investment for 30 years than if you invested only for 1 year or even for 1 month. You'd expect to get even less, right? Because you're locking your money up for longer, so you'd expect a greater return. And I'll read this from the site here. It says, as bonds with longer maturities usually carry higher risk, such bonds have higher yields than the bonds with shorter maturities. Due to this, a normal yield curve reflects increasing bond yields as maturity increases. So that would be a normal yield curve. However, the yield curve can sometimes become flat or inverted. So that's what we're looking at here. And so this blue line is representative of the difference between the 10-year and the 1-year rates that you get when investing in each of those particular bond maturity dates. And so when the difference between the 10-year subtracted from the 1-year becomes negative, it goes below this red line here. And you can see that's happened a number of times in the past 50 years that are displayed on this chart. Now, what's interesting about that is that every single time there's an inverted yield curve, again, that means the blue line went below the red line here, it's been followed by a recession. And as you can see at the bottom of this chart, it even says right here, an inverted yield curve has predicted the past 7 recessions. I believe it's 8 now, actually, with COVID. A very small recession. And then soon to be 9. And so you can see, and by the way, the recessions are marked by these gray vertical bars, okay? Each one of these gray vertical bars is a recession. So you have one, I'll try not to cover it up. There's 1, there's 2, 3, 4, 5, 6, 7, and then there's a little one for 8, and then we're heading into the 9th one. And every one of those gray vertical bars, aka recessions, is preceded by an inversion of the yield curve, meaning the blue line went below the red line. Okay, so that's why an inverted yield curve is such an important indicator, because it has basically a flawless track record for predicting recessions. So I'm not just saying this lightly. Now, I'm not just saying we're going to crash massively in a couple years lightly. It's because of this plus the other metrics, and they all back each other up. Okay, so now that we understand what a yield curve is and the fact that every time it inverts, it predicts uniformly a crash coming up in the future, we need to look at how long does that crash take to play out. Okay, so this graph here, this green and red, is really showing you the same thing that we were looking at right here. Every one of the dips below the red line is indicated by a red color here. And anytime it's green means that The blue line here is above the red line. These two charts are showing you the same thing, just so you understand right here, okay? So here we can see, again, the inversions as a red color. So let's look at how this plays out. This is what happens, okay? First, you have a yield curve inversion indicated by red. That's the first step. The second step is you have the Fed funds rate climbing, plateauing, and then dropping. Coincident or latent with that happening, with the Fed funds rate climbing, going flat, and dropping, you have the stock market peaking out, usually a little later, and usually crashing after that fact. And usually it crashes to its bottom after the Fed funds rate has gone all the way back to zero or basically back to zero. That happened in the 2000 bubble, that happened in 2008, and that happened briefly in COVID, where you have 1, 2, 3. You have yield curve inversion, Fed's fund rate up and down, stock market crash. Yield curve inversion, Fed's fund rate up and down, stock market crash. Again, here, there's a little red blip. It's hard to see, but even in COVID, yield curve inverted briefly. Fed's fund rate up, down, stock market crash briefly. It seems to be somewhat commensurate with the size of the yield curve as well. Well, what do we have right now? We have the largest and deepest yield curve inversion that we have seen in over 40 years. This is bigger than 2000. This is bigger than 2008. This is no small yield curve inversion. And so if we go back again to this chart here, what does this massive yield curve inversion indicate? What is it predicting for us? Well, it's showing that there's a recession coming. And so what's the sequence? The yield curve inverts, the Fed raises the interest rates via the Fed funds rate, and that's exactly what they've been doing. And they're nearly done raising it. It seems like they're beginning to plateau. Well, what happened in the past cycles? The exact same thing. We have it raising, plateauing, and then dropping. And see how the crash occurs? If you look at the Fed funds rate right below the stock market crash here, you can see that it went back down to zero. That's basically the bottom. Now, I want to introduce one more thing, and this was not present in any of my past videos, and that's the fact that we also have another correlating and corroborating metric. That is the unemployment rate. Notice how every time the stock market crashes and it's at its bottom, the unemployment rate is at its or near its top. See, here's the stock market crash in 2008. Here's the unemployment rate near its peak. And if you line it up, it's right there. It's near the peak, right? And what do you have also conversely? You have every time the unemployment rate is near its lowest is when you're at the peak of the stock market. That's very interesting because where are we right now? We're at the lowest or near the lowest. And what do we have? We're almost making a new all-time high. It matches almost perfectly. And so I'll give you another example. Back in 2000, so we had the yield curve invert, we had the Fed's fund rate increase, decrease, we have a crash right here, stock market crash in 2002, the bottom, right? And that is approximately where the peak relative to that cycle was for unemployment. And let's look back even further. How about the peak before that? The best time to sell, right? In 2000, August 2000, unemployment was at its absolute lowest. This pattern repeats, just like all the other patterns repeat. So how can we use that? We can use that by not only looking at when the Fed funds rate flattens off and begins to drop, because that's telling in itself, but we can also look at the unemployment rate right down here. And we know that we're not near the bottom of the crash because unemployment is basically at its lowest ever. We need to see unemployment start to go up. And that's exactly the Fed's goal if you haven't been listening. So when the unemployment rate begins to climb like this, that's when we know we're getting toward the bottom of the stock market. That's when we know the bottom will occur. Because when we're at the high or the relative high, that's where the stock market has crashed to its bottom. So people who think that there's not a crash coming are ignoring everything on this chart. All four of these charts, they're ignoring. They have their heads in the sand and they're saying, we're going up and to the right, up only. Who cares? Who cares about the unemployment rate? Who cares about the Fed funds rate? Who cares about the yield curve inversion, which all say the same thing? They all say that a crash is coming and that it's not yet. Okay? So when we see the unemployment rate climb, when we see the Fed funds rate flatten off for maybe a year and then begin to drop, red alert, like the stock market crash is coming. And I don't say this to be negative. I'm saying this because it's what the charts are showing and it's what the government has given us. They didn't hand us gold on a silver platter. They handed us shit. So now we have to deal with that. And so we need to be nimble and we need to be able to turn a disaster, a manufactured disaster, which none of us wish was happening, into an opportunity. Because any disaster can be turned into an opportunity if one is positioned correctly. And that's what my entire thesis is about for the next several years. Now, that doesn't mean that we're immediately crashing, because note, there's some delay to all of this. Again, we're at the lowest point of unemployment. We're at the beginning stages of flattening off for the federal funds rate. And what we have seen in the past, let's look right here. When the federal funds rate first flattens off right here, what do we have with the stock market directly above it? Look at this. From here to here is a massive climb from September 2006 to November 2007. We have the market climbing. That's why the market is climbing right now, because it can remain irrational longer than we can remain solvent, longer than we would expect. It doesn't make sense. We just had a yield curve inversion. The market should be dumping. And it is, but it's in slow motion. It's a slow motion disaster. It's a very slow motion lag. The lag fools everyone. Everyone thinks that the markets are doing great. I guarantee you, in 4 to 6 months, if the market continues going up, people are going to be so damn bullish. When it breaks its all-time high, people are going to be so freaking bullish. Oh my God, all-time highs. The stock market is breaking new all-time highs. Recession canceled. Watch this. The headlines will say this. Recession canceled. There is going to be a devastational crash after that. Do not be fooled. Unless it invalidates every chart that you're looking at right here and the past 30 years of data or more. So let's jump into some of the minutia, some of the details in some of these charts, because I found this really awesome resource. This is the original article from Fundrise. The creator of this was Benjamin Miller, or at least he shared it. I don't know if he actually wrote the article. He might have. He himself said, the stock market rally is a FOMO trap. The long lag between interest rate hikes and a recession is misleading investors. Now, it depends on what time frame. I think I'd have to add that caveat, because if you only plan, like I said at the beginning of this video, if you only plan for the doom and gloom situation, you could miss a tremendous euphoria, tremendous parabolic climb up before that crash. Now, it's a bit of a game of chicken, because when do you sell? That is the guess. And I'm not trying to say that I am going to tell you exactly when that is, because I don't know. I'm playing the game of chicken here with you. I'm trying to guess it correctly so that I can take profits and then not have all my holdings subjected to the biggest downturn over the next several years that we have seen in 30 years perhaps. But it is a long lag, and that's why so many people get fooled. So he created, or his company created, these charts, and I think they're awesome because they're so clear. And I encourage you to pause the video at any or all of these charts and just analyze them and look at them for yourself and really digest what it's showing here. Now, it doesn't show the inverted yield curve and it doesn't show unemployment, but we already looked at that. We know that it corroborates what this is showing. So this is like a zoom in on the timings of things, because people want to know, do I buy? Do I sell? How long do I hold? These are the questions. People want useful information that they can act on. And so I think that this zoom in gives us the most useful information. So here we're all the way back in the 1960s, okay? Now, he's got his charts aligned a little bit differently than mine, in that I count things from when the Fed funds rate, after it's gone flat for a while, begins to decrease. That's when I started my timer. He starts his timer from the moment that the Fed funds rate goes flat. It's totally fine. In fact, I like his method. It's a good method. So the Fed funds rate and all of these examples, as you'll see, climbs from a lower rate to a higher rate, plateaus, and then drops. And so he starts his clock from the moment it plateaus. And the key takeaways from these charts are that in this case, it took 13 months from the moment that the Fed funds rate began plateauing, which is roughly where we're at right now. Let's put that in perspective, because the Fed is very close to being done with raising rates. Maybe they'll increase the rate one more time or two more times by the end of the year, but I think they're getting very close. They're tapering off these rate increases, right? So let's say that we're approximately where this dot is. Maybe we're even a little before where this dot is, okay? So if anything, add a month or 2 or 4 to this estimate. But it's approximately where we're at right now. And so it says that there was, in the 1960s, 13 months from the moment that the Fed went flat on the Fed interest rates to the bottom of the stock market crash at that time. And at that time, it was a 39% loss from the previous peak. Let's move forward to the next chart in the early 1970s. Again, you have the same phenomena. The Fed funds rate increases, plateaus, and drops, and you have a stock market crash. This time, it took 14 months from the moment the Fed funds rate begins to go flat till the bottom of the stock market, 14 months, and there was a 55% loss. Here we have the dot-com bubble. This is the 2000 bubble, ended in 2002, and the Fed funds rate increases, goes flat, and decreases. And it took 27 months from the beginning of when the Fed's fund rate started to go flat to the actual bottom. So this was over 2 years of collapse. Now keep in mind, we currently have the greatest yield curve inversion we've ever seen. And so I'm not saying for sure that indicates we're going to have the biggest crash we've ever seen. I personally think we will because of what's underlying that. There's a reason the yield curve is so inverted. Let's put it that way. And so we have 27 months from the moment the Fed funds rate begins to go flat to the bottom of the stock market crash. And in this case, it was a 50% or 49% loss from the peak to the valley. Notice that we haven't had even close to that big of a drop. Here's the Great Recession, 2006 to 2008. Fed funds rate is increasing, flattens off, and drops. Same exact pattern, okay? How you could ignore this, I don't know. Now, how long did it take from the moment the Fed began flattening off the Fed funds rate, the interest rates? 31 months from that moment they began flattening the Fed funds rate to the bottom of the stock market crash. And in this case, it was a 53% loss from the top. So I encourage you again to look at these charts. I think they're very telling. And if you want to look at some averages, if you take all these different crashes from the last 50 or so years, and you look at the lag of the peak to the stock market bottom, it was a 21-month average lag from the peak of the interest rate, from the moment that the Fed begins flattening off the federal funds rate to the actual bottom of the stock market crash is 21 months on average. It could be more, could be less. And the total decline was on average 43%. So I guess I would ask you this question. If the yield curve is inverted the most it's ever been in the last 50 plus years, and there's a reason for that, and the US government and governments around the world printed the most money they've ever printed for the COVID pandemic. Yes, all of this is in response to the COVID pandemic and also just the built up, pent up energy of a 15-year secular bull market with zero interest rates across the boards. What do you think are the chances that this isn't among the larger crashes? I think that there is a preponderance of evidence here that point to this being one of the larger crashes. So if we just take the averages, I think that's actually being kind of conservative in this case. So let's do that. Let's take the averages and let's say that it's a 43% decline from the peak to the trough. Well, that's definitely more than we've seen already. And especially if we start making new all-time highs, then we've really got a drop to have from that all-time high point, perhaps later this year, early next year. And lastly, I just want to show you this new metric, the unemployment rate, how reliable it is in indicating a market bottom when it peaks, and inversely, a market top when it bottoms. So again, this teal line down here is the unemployment rate, and here, so I'm going to put my cursor on the stock market directly above it, and you can follow the line down from there. And look at this. You can see it's not a huge crash, but it's still the bottom of the market at that time. And what's the unemployment rate doing? It's topping out. Right here, we have a little dip down to its low at that point in time, and you have the unemployment rate approaching its top. Every one of these moments, look at this, it's accompanied with the unemployment rate approaching its peak. There are a couple that don't correlate with it approaching its peak, like this one and this one right here. But let's get back to another one that correlates. Boom, right here, approaching its peak of unemployment, a bottom of the stock market. Now, these may not look like big crashes at the time, but I guarantee you in this time, if we zoomed in, this was a big crash. It looks small on this chart. Like if I scale it, you can see that actually is a big crash. And if you were living in this time, that would have been an enormous crash to live through. So we have to keep it in perspective here. So again, look at, here's a dip, a bottom of the market. What's the unemployment doing? It's peaking out. It's kind of eerie. Let's look at the 2000 crash. Here, the unemployment rate is topping out for its relative cycle and the stock market is crashing. 2008, unemployment rate on the bottom there is topping out and the stock market is crashing. And so the fact that we're nowhere near the top, in fact, we're about as low as you can go with unemployment, just means that the Fed is going to need to do some more damage because they need to keep inflation under control and they cannot have it be long-standing inflation. And so let's look at each of these past crashes and simulate where we are now, which is basically the black dot, and go, how high could the stock market go and for how long? Now, in the late 60s, the market was just dropping. The market was going down at that point. So if we were there now, it would be going down. In the 1970s, let's say this is where we are now, what was happening? Okay, again, the stock market was crashing at that point. Again, in the dot-com bubble, we were actually just about peaking out. It looks like we peaked out. I'm almost like a triple top here. But in the middle of 2000, we were actually hitting our peak right after the Fed stopped raising its interest rates. Now that might be coming up pretty soon. So the first three charts I showed you are examples of why the crash could start happening at any time. Because in those examples, the market was crashing already when the Fed began flattening off its Fed funds rate. Now in the dot-com bubble, it looks like we could have another 3 to 6 months. You know, if this was where we were today and this was the market then, we could have another 3 to 6 months before the huge multi-year drop begins. And in the Great Recession, the housing crisis, if this is where we were today, then look at this. The market actually continued to climb almost all the way to the point where the Fed began dropping the interest rates. And so in this case, if this was us today, it would mean that we could have a year of climbing to go. And this is the variety. I'm not trying to be overly broad or inaccurate. I'm actually trying to be extremely accurate and looking at how it played out in all these past examples to show you how much variance there is, how much variety of time frame there is. It could happen next week. We could start having a crash. It really could per these charts. Or we could make new all-time highs and the market could climb for another 12 months, 10 or 12 months, let's say something like that. That could be what we see this time. Every market cycle is a little different, but they have these broad patterns that rhyme, and that's what I'm trying to explain to you. So I really want to make it clear that I'm not expecting the crash to guaranteedly happen tomorrow or in 3 months or in 6 months. I'm saying that the crash is going to happen, very likely, but it could be any time starting in the next 0 to 10 months. That's when it will start. So that's why I'm calling it a game of chicken. It really is. It's a game of chicken because while we may think we know when the market's going to begin to tank, we don't really. I'm going to be looking at that unemployment. I really am. That's one of my key metrics. Unemployment. When it starts going up, I'm going to get very cautious and begin to take profits. That's one of the new metrics that I'm really happy about looking at. But it's a game of chicken because we don't know when is it going to be 1 month or 10 months or 4 months. And like we said at the beginning of this video, timing is everything. If you're off by 2 months and the market drops by 30%, your portfolio could be devastated. Timing is very important. So we don't know the exact timing, but we do see what's about to happen. It's these broad brushstrokes that we're trying to look at here. And the Fed funds rate almost always goes down coinciding with when unemployment is going up, because I think that's generally the Fed's goal, is to cripple the economy and to cause unemployment. And so when they finally start seeing unemployment begin to uptick, they begin dropping their rates, like right here. And you can see then that is timed with unemployment skyrocketing. So these are our clues. These are our clues to when the bottom is near, when the crash is nigh. It's when the Fed funds rate goes flat for some period of time. We don't know, 1 month, 10 months. And when the unemployment rate begins to go up. When the unemployment rate starts to uptick, that is my sign to start taking profits. This is the best indicator that I see currently. Take profits when the unemployment rate starts to rise. I hope this was helpful to you guys, and I hope this clarifies my position, both the medium term, short term, and the long term. They're different strategies. And it is a game of gambling. It is gambling. It's a game of chicken. We don't know exactly when it's all going to come crashing down. But it is reasonable to expect that the market could rally for some number of months from 0 to 10. And then it's reasonable to expect the market's going to crash for some number of potentially years after that, based on what we're looking at here. So short term, bullish, medium term, uncertain, long term, bearish as F. Thank you so much for sticking with me through that fairly long video. I know it was a lot of information, but I really wanted to make my case, and I hope you're seeing what I'm seeing. A lot of people on Twitter just say it's ridiculous and that it's never going to happen. But if you really watch these indicators, I mean, can you really dismiss the likelihood of this at least being a possibility? I think that if you dismiss it entirely, it's showing your bullish bias. And I think that that could be just as harmful as having a perma bear bias. And I don't want anyone to make that mistake. I think we should all keep our eyes open to the possibilities, especially when this could be the largest wealth generation and wealth transfer opportunity, like generational wealth opportunity that we see in our lifetimes, one of the largest. How often does the United States double its monetary supply in a year, like it did with the COVID pandemic, and then create massive inflation and then all these reciprocating effects where it results in a cataclysmic crash of the economy and the stock market and perhaps cryptocurrencies in general? How often does that opportunity come around? And it's not to say that we want that to happen. If it was up to me, I would just continue having a secular bull market. I would love for us all to just go up, up, up and right only, right? That would be awesome. But that's not how the world works. Governments manipulate. Governments cause devastation. They cause people to lose money, and they shift money from the weak hands into the strong hands. And it's the wealthy that tend to have the strong hands. I want us to be among those individuals. And so I'm trying to play the game with an edge so that we can come out on top. And that's all I hope to do. With any great disaster comes great opportunity if you know what to look for. Let's look for it, guys. Have a great day.